Imagine you buy a $2,000 television. You swipe your credit card. The television comes home with you that afternoon. But the bill? That can follow you for months, sometimes years. And here's the strange part. Your credit card company doesn't necessarily want you to pay the entire balance tomorrow. It wants you to keep using the card. Keep carrying a balance. Keep making payments. And keep paying interest. That doesn't mean every credit card company secretly designed a system to trap you. Credit cards can be incredibly useful when they're used correctly. But the business model creates a powerful incentive. The longer you borrow, the more money the system can make from you. And once you understand how that system works, something becomes clear. The most expensive part of a credit card isn't the plastic in your wallet. It's the time between the purchase and the day you finally stop owing money. Welcome to Money Explained Differently, where we uncover the hidden side of money and explain the financial stories most people never see. Let's start with a simple American household. Imagine a couple named Daniel and Sarah. They have jobs. They pay their bills. They aren't reckless with money. One year, their refrigerator breaks. Then the car needs repairs. Then their child needs an unexpected medical expense. Suddenly, they have $3,500 in expenses they didn't plan for. They don't have $3,500 sitting in checking. So they reach for the credit card. And emotionally, the decision makes sense. They aren't buying luxury watches. They're solving problems. The card gives them something incredibly valuable. Time. They can pay today and worry about the money later. And that is one of the most powerful features of modern consumer credit. But then the monthly statement arrives. The balance is $3,500. The minimum payment might look manageable. Maybe it's a few dozen dollars. And that's where the psychology changes. Instead of thinking, I owe $3,500, the human brain starts thinking, I can afford this month's payment. That difference is enormous. Because the minimum payment is designed to keep your account current. It is not necessarily designed to get you out of debt quickly. And this is where the credit card system becomes fascinating. A credit card is essentially a short-term loan that can repeatedly renew itself. You borrow. You repay. You borrow again. And if you carry a balance, interest can accumulate. The company earns money from several sources, depending on the card and how you use it. There can be interest charges. There can be annual fees. There can be late fees. And there is also something most consumers rarely think about. Merchants generally pay processing-related fees when customers use cards. So the credit card business isn't dependent on one single customer behavior. But for revolving credit, there is an especially important difference. A customer who pays the entire statement balance every month may generate relatively little interest revenue. A customer who carries a balance for years can generate much more. And this is the part that deserves careful attention. The system doesn't have to be a conspiracy to create a powerful incentive. It simply has to be profitable. Think about a bank. A bank lends money. The borrower pays interest. The longer the money remains borrowed, the longer there can be an opportunity to earn interest. That's the basic economics of lending. It's the same reason mortgages exist. It's the same reason auto loans exist. It's the same reason businesses borrow money. The difference with a credit card is that the borrowing can be extremely easy to repeat. You don't have to walk into a bank every time you want another loan. You can simply tap, swipe, click, and move on. That convenience changes human behavior. Imagine walking into a store carrying a briefcase filled with cash. You would physically see the money leaving your hands. But with a credit card? Nothing disappears from your wallet. There is no empty space where the money used to be. The pain of payment becomes delayed. Behavioral economists have studied this basic idea for years. When payment feels less immediate, spending can feel easier. And credit cards take that concept to an entirely different level. You can buy dinner tonight and deal with the financial consequences later. You can buy a $1,500 laptop. You can book a vacation. You can replace a broken air conditioner. You can order furniture. The transaction ends instantly. The debt doesn't. But this is where most people get surprised. Credit card companies aren't necessarily trying to make every customer carry debt forever. In fact, customers who pay on time and use cards responsibly can be extremely valuable too. They may use the card frequently. They may generate merchant transaction revenue. They may remain loyal to the bank. They may eventually take other financial products. And responsible card users can receive meaningful benefits. Cash back. Travel rewards. Purchase protections. Fraud protection. Convenience. The problem isn't that credit cards are inherently bad. The problem is what happens when convenience combines with expensive revolving debt. Consider two people who both spend $10,000 on a credit card during a year. Person A pays the statement balance in full. Person B makes only the required payments and continues carrying a balance. They used the same piece of plastic. They bought similar things. But financially, they are living in completely different worlds. Person A may receive rewards while avoiding interest on purchases that qualify for the grace period. Person B may spend years paying for purchases that are already long forgotten. And that's one of the strangest features of consumer debt. You can still be paying for something long after you stopped enjoying it. The vacation is over. The restaurant meal is gone. The smartphone is 2 generations old. The furniture has been replaced. But the balance can remain. And the interest doesn't care whether you remember what you bought. This is why minimum payments can be psychologically dangerous. Let's imagine you owe $5,000 on a credit card. Suppose, purely as an illustration, that the annual interest rate is 24%. That's about 2% per month before accounting for how the issuer calculates interest. At the beginning, the interest can represent a significant amount of the balance. If your payment is only slightly above the interest being charged, your principal falls slowly. You may feel like you're making progress. But the balance can move much more slowly than expected. And if you continue adding new purchases, the finish line moves farther away. This is the real trap. Not one purchase. Not one interest charge. The cycle. Borrow. Pay. Borrow again. Pay. Carry the balance. Spend again. And repeat. Now imagine that cycle operating inside an entire economy. American consumers don't just use credit cards for emergencies. They use credit cards for everyday spending. Groceries. Gas. Restaurants. Online shopping. Travel. Subscriptions. And increasingly, purchases can be split into installments or financed through various forms of buy now, pay later credit. The technology changes. The fundamental idea doesn't. Consume today. Pay later. And that message is incredibly powerful. Because humans are naturally much better at understanding today's pleasure than tomorrow's cost. If someone offers you a $2,000 purchase today and says, "Don't worry about the full cost until later," the psychological barrier falls. And retailers understand this. A $2,000 product sounds expensive. But $100 a month? That sounds manageable. The monthly payment hides the total commitment. The same psychology appears in cars. A $45,000 vehicle can be framed as a monthly payment. Mortgages are discussed through monthly payments. Furniture can be financed through monthly payments. Phones can be sold through monthly payments. And credit cards can turn almost anything into a series of future obligations. But here's an important distinction. Monthly payments aren't automatically bad.
Most Americans could never buy a home without a mortgage.
Businesses often need financing to grow. A car loan can make sense when transportation is necessary. Credit itself is not the enemy. The danger comes when the payment becomes more important than the total cost. Because when you focus only on the payment, you can lose sight of the price. And there is another hidden factor. Inflation. When prices rise, households can feel squeezed. Groceries cost more. Housing costs more. Insurance costs more. Utilities cost more.
Wages may rise, but not always at the same pace. So some families start using credit cards not because they suddenly became irresponsible, but because their financial margin disappeared.
A temporary problem becomes a balance.
The balance creates interest. The interest increases the required payment.
The payment reduces the money available for next month's expenses. And then the card gets used again.
That's how a financial cushion can slowly become a financial treadmill.
But there's another side to this story. Credit cards can actually help people build credit history.
A strong credit profile can affect the cost and availability of future borrowing. That matters when you're buying a house, financing a car, renting an apartment, or applying for certain financial products. And credit cards can provide a useful emergency buffer when someone has no better option.
The key is whether the card is being used as a payment tool
or as permanent financing.
Those are two completely different things.
If you charge $1,000 and pay the statement balance in full, the card is functioning largely as a payment mechanism. If you charge $1,000 and carry the balance for 2 years, you're using expensive revolving credit.
The difference can be enormous. And this is where we need to talk about rewards. Cash back and travel points sound like free money. But they aren't magic. The economics only make sense if the overall system remains profitable for the issuer.
Some customers earn rewards while paying no interest. Other customers carry balances and pay substantial interest. The broader business model can accommodate both.
And this creates an interesting paradox. The same credit card can be a financial tool that saves one person money, and a financial product that costs another person thousands. Same card. Different behavior. So ask yourself, which customer does the system reward? Usually, the customer who understands the rules. The customer who knows the interest rate. The customer who knows when interest begins. The customer who understands the statement balance versus the minimum payment. The customer who doesn't confuse available credit with available income. That last one is especially important. Your credit limit is not your money. If your bank gives you a $15,000 limit, that doesn't mean you suddenly have $15,000 more wealth. It means you have access to $15,000 of borrowing capacity.
And borrowing capacity can feel dangerously similar to wealth when you're standing at a checkout counter. This is where credit cards become connected to one of the biggest financial illusions in America. The illusion that affordability equals the monthly payment.
Something isn't necessarily affordable because you can make the payment. A $700 monthly payment can be affordable.
Or it can be the final straw in a household already carrying $50,000 of other obligations. The number only makes sense in context.
And that is why financially healthy consumers don't just ask, "Can I make the payment?" They ask, "How much will this actually cost me? How long will I be paying for it? What happens if my income drops? And what am I giving up by committing this money in the future?" Those questions completely change the decision. Now let's come back to the title. Was the credit card system designed to keep you paying forever?
Not exactly in the sense of some secret meeting where executives decided that Americans should never escape debt.
That's too simplistic.
But the system was built around revolving credit, interest, consumer spending, and repeated use.
And those mechanics can absolutely produce long-lasting debt when consumers continually carry balances. The incentive is not necessarily keep this person trapped forever. It's closer to keep the customer using the product. And if that customer carries a balance, the financial relationship can become very profitable. That's an important distinction. Because understanding incentives is more useful than believing in conspiracies. A business doesn't need to hate you to make money from you. It only needs a business model that rewards a certain behavior. And in credit cards, one of those behaviors is borrowing. The final surprise is that the most powerful weapon isn't the interest rate. It's habit. Once someone becomes comfortable putting expenses on a card, the card stops feeling like debt. It becomes the default way they pay. That psychological shift can be more powerful than any advertisement. Because eventually, the question changes from, should I buy this? To, which card should I use? And when that happens, borrowing has become invisible. So what can you do with this knowledge? You don't have to destroy every credit card you own. You don't have to fear all debt. You simply need to understand what game you're playing. If you're using a credit card for convenience and paying the statement balance in full, you're operating very differently from someone financing everyday consumption at a high interest rate. Know your interest rate. Know your statement balance. Know your minimum payment. Know when interest applies. And most importantly, know the difference between money you have and money someone is willing to lend you. Because those are not the same thing. So here's the question. Do you think credit cards are mostly a useful financial tool, or do their rewards and convenience encourage people to spend more than they should? Share your opinion in the comments. Because there is a legitimate debate here. Credit cards can provide convenience, rewards, consumer protections, and access to short-term liquidity. But the same system can become extremely expensive when convenience turns into revolving debt. And that may be the biggest lesson of all. The credit card isn't what keeps you paying. The cycle does. You buy something today. You postpone the pain. The balance survives. Interest gets added. You make a payment. Then another purchase arrives. And suddenly, you're not paying for what you bought today. You're paying for yesterday. And tomorrow's purchases are waiting in line behind it. The financial system doesn't need to force you into that cycle. It only needs to make the cycle easy. And that's why understanding how credit works is so much more powerful than simply being told to use credit responsibly. Because once you can see the incentives, once you understand the psychology, and once you recognize the difference between convenience and debt, the credit card stops looking like free money. It becomes what it really is. A financial tool. And like every powerful tool, the outcome depends on who controls it. If you want to discover more hidden truths about money, subscribe to Money Explained Differently. We explore the financial stories behind the decisions that shape everyday life.